Walk into any commercial gym on a Monday evening at 6 o'clock, and you will witness what appears to be the most effortless, guaranteed cash printing engine in American retail real estate. Every single treadmill is running at maximum incline. The squat racks are completely occupied. The weight floor sounds like an industrial assembly line, and the line at the front desk stretches past the juice bar. To the untrained eye of an aspiring entrepreneur, the math feels hilariously simple. Count the human bodies in the room, multiply them by a monthly membership fee, and watch a passive stream of recurring cash flow flood into your corporate bank account every 30 days. You look at that packed floor and think to yourself that the owner of this building must be retiring at 45. Here is the brutal financial reality. You are looking at the exact 1 hour of the day that lies to you the most. The fundamental trap of the fitness industry begins with a total misunderstanding of what business you are actually operating. A gym is not a health or wellness business. It is not a sports performance facility, and it certainly is not a community public service. A gym is a leveraged subscription business that simply happens to store several tons of heavy steel dumbbells inside a leased commercial box. The moment you strip away the motivational slogans on the wall and analyze this industry through the lens of institutional finance, every bizarre operational decision, from why the doors are practically impossible to lock you out of when joining, to why canceling your account requires a certified letter sent to a post office box in another state, starts to make absolute mathematical sense. Welcome to the brutal economics of owning a gym, where your facility relies on people buying access to a room they hope never to enter, and where a packed parking lot can still sit directly on top of a business heading straight into Chapter 11 bankruptcy. Before you spend a single dollar on lease deposits or heavy equipment catalogs, you have to realize that the term gym does not describe a single business model. It covers 5 completely distinct financial vehicles, each making a radically different bet on human behavior and unit economics. At the absolute bottom of the pricing pyramid sits the high-volume budget chain. These are $10 to $25 a month operations that occupy 30,000 square feet of suburban retail space, the size of a mid-sized grocery store. They fill the floor with hundreds of identical cardio machines, ban aggressive weightlifting, and run on a skeleton crew of 2 or 3 minimum wage front desk attendants. A single location here does not survive on hundreds of members. It requires 6,000 to 10,000 paying subscribers to make the unit economics work. It is a pure volume game where unit margin per customer is paper thin, but operational overhead per square foot is kept aggressively suppressed. One step above sits the traditional mid-tier commercial gym, charging $40 to $70 a month. Here, members expect a balance: free weights, squat racks, group fitness classes, locker rooms, and basic amenities. The labor costs are higher, the equipment wears out faster under heavier loads, and the facility exists in constant combat with customer churn. Above that sits the luxury health club sector, where monthly dues start at $150 and easily scale past $300. In this tier, you are not selling access to a bench press. You are selling social status, networking, high-end spa treatments, executive co-working lounges, and pristine eucalyptus towels. The capital investment is staggering, but the high price tag acts as a filter, attracting affluent members who view the monthly fee as a mandatory lifestyle utility rather than a discretionary expense. Then you have the boutique studios-focused microspaces, under 3,000 square feet, dedicated entirely to a single discipline like Pilates, cycling, or high-intensity interval training. They throw away the monthly subscription model in favor of $50 to $150 monthly tiers or high-margin class packs, trading massive footprint requirements for maximum revenue generated per square foot during class hours. Finally, at the smallest extreme sits the one-on-one personal training studio. Sometimes operating out of a tiny 500 square foot footprint, these facilities sell 0 memberships. They sell the physical labor and billable hours of elite coach. Every single one of these choices forces you to make the foundational gamble of retail economics. Do you build a massive machine that extracts $10 a month from 10,000 Ghost members, or a tiny boutique that extracts $500 a month from 100 dedicated fanatics? Get this choice wrong relative to your local market, and your balance sheet is dead before you even hang the front sign. The most dangerous illusion for a first-time gym owner is believing that the most expensive part of opening the doors is buying the fitness equipment. It isn't. The most aggressive cash-draining pit in this entire industry is taking a cold, empty commercial concrete shell and legally converting it into a space that can safely handle 200 sweating, heavy-breathing human beings simultaneously. Before you even touch a hammer, your commercial landlord will demand 3 to 6 months of full rent paid up front as a security deposit, just to grant you access to the lease. Then comes the build-out. Standard commercial carpet or vinyl flooring will disintegrate within 90 days under heavy athletic use. You need specialized, high-density industrial rubber flooring capable of absorbing the repeated impact of a 500-pound dropped barbell without shattering the structural concrete slab beneath it. That rubber alone will comfortably cost $10,000 to $40,000 just for material and specialized installation. Next are the plumbing and locker facilities. A retail store sells shirts on racks. A gym requires moisture-resistant drywall, commercial-grade drainage, industrial hot water heaters capable of handling back-to-back showers, and antimicrobial ventilation systems to prevent mold outbreaks. Plumbing retrofit costs routinely consume $10,000 to $50,000. Add floor-to-ceiling mirror arrays to cover thousands of square feet, and you are writing another check for $3,000 to $12,000. But the silent budget killer that almost every amateur operator completely underestimates is air movement. A standard retail air conditioning unit is engineered to keep 4 store clerks cool while sitting at a cash register. It is completely incapable of handling a room filled with dozens of athletes, generating body heat and moisture. Municipal building and health codes are merciless on this point. They require a specific, legally mandated formula for fresh air exchanges, roughly 20 cubic feet of fresh outside air per minute for every single person exercising inside the building, on top of the base square footage requirement. Run that engineering formula on a modest 5,000 square foot floor, hosting 100 members during peak hours, and your system must pump in well over 2,000 cubic feet of fresh outside air every single minute of the day. That is not a couple of ceiling fans. That is a complete industrial-grade rooftop HVAC replacement. An HVAC upgrade alone will routinely demand $10,000 to $50,000 in unrecoverable capital expenditure before a single paying customer ever steps foot inside your facility. When you add up lease security deposits, structural build-outs, architectural permits, municipal compliance fees, liability insurance, and the mandatory working capital reserve required to survive the initial slow months, unlocking the front door of even a modest, mid-sized commercial gym demands anywhere from $300,000 to over $1 million in liquid capital. Once the building is legally compliant, you finally face the hardware catalog. Commercial-grade fitness equipment is not the consumer machinery you buy at a department store. A single commercial treadmill engineered to withstand 12 hours of continuous daily abuse costs between $2,000 and $8,000. A functional cardio bay requires 8 to 12 of them. Selectorized cable strength machines run $1,000 to $5,000 per unit, and a proper gym floor requires 15 to 20 distinct stations. Factor in heavy-duty power racks, cast-iron dumbbell sets, adjustable benches, and cable accessories, and your initial equipment bill lands squarely between $40,000 and $250,000. This introduces the critical financial crossroads that breaks most first-time operators. Do you buy the equipment outright with cash, or do you enter into equipment lease financing? Buying outright means owning the assets clean on your balance sheet with zero ongoing monthly equipment debt. But doing so completely drains your cash reserves at the exact moment your business is most fragile, during those first 6 months when membership numbers are far below break-even. Furthermore, cardio machinery has a brutal depreciation curve. Belts wear out, electronics fail, And after 4 years of relentless daily pounding, your $80,000 cardio bank looks dated and requires massive overhaul capital. Leasing sounds like the sophisticated Wall Street solution. You preserve your precious liquid capital, lower your upfront cash outlay, and keep low monthly payments while structuring a contract that allows you to rotate in fresh, modern equipment every 3 to 4 years. Here is the catch. Commercial equipment lease financing carries aggressive effective interest rates, often sitting around 8% annually. Over the 3 to 5 year term of that lease, you pay far more in cumulative capital than the machinery was originally worth. Worse still, an equipment lease is an ironclad, senior secured debt obligation. The leasing firm does not care if your gym experiences a slow summer, if a low-cost competitor opens across the street, or if you lose half your membership base. The lease contract demands its monthly remittance, regardless of foot traffic. If the business fails, that lease obligation follows the owner personally through personal guarantees, transforming what seemed like a flexible operational choice into a relentless fixed financial overhang. In traditional retail or e-commerce, your addressable market can span an entire metropolitan area or an entire country. In the commercial gym business, your total addressable market is bounded by an unforgiving psychological wall, the 10 to 15-minute drive time. Industry data confirms that approximately 80% of a gym's total active membership base lives or works within a 10 to 15-minute radius of the building's front door. That is your entire world. People will not drive 30 minutes past 3 other options to squat at your facility, no matter how shiny your barbells are or how inspirational your Instagram page looks. This micro-market dynamic creates an extreme real estate trap. Inside that strict drive time bubble, the median household income must perfectly match your business model pricing. Placing a luxury health club, charging $150 a month inside a middle-income suburb built around budget retail options, is instant suicide, regardless of how beautiful your sauna is. Conversely, placing a $10 budget high-volume gym inside a high-density, ultra-expensive urban core, where commercial rent commands $25 to $120 per square foot per year, will destroy your margins instantly. In rural or suburban strip malls, commercial space might cost $12 to $20 per square foot, but the underlying population density within that 15-minute bubble may be far too sparse to support the thousands of members required to pay the bills. Select the wrong side of this real estate equation, and you lock yourself into a long-term lease contract that demands a volume of members your surrounding neighborhood literally cannot supply. Now we arrive at the operational core of the gym industry, the single financial concept that explains why this business behaves unlike almost any other trade on earth. Picture 2 distinct individuals signing up for a gym membership on the exact same afternoon. The first individual is a dedicated athlete. They show up 3 days a week, every single week, 52 weeks a year. Every time they walk through the doors, they take a hot shower, consuming water and gas. They grab laundered towels. They put physical friction on the treadmill belts, drop dumbbells, wear out cable pulleys, and take up physical floor space during peak hours between 5 and 8 in the evening. Their presence creates floor congestion, increasing wait times for equipment, which actively frustrates other members and pushes them toward cancellation. In financial terms, this dedicated member carries a high marginal cost of service. They cost the gym real operational dollars and real capacity every single time they exercise. Now look at the second individual. They sign up on January 2nd during a burst of motivation, visit the gym twice, feel great about making a lifestyle change, and then never set foot in the building again for the remaining 11 months of the year, while their monthly credit card charge continues to process like clockwork. Which of these two customers is more valuable to the business owner? It is the second member by an overwhelming financial landslide. The inactive member uses 0 gallons of hot water. They wear down 0 treadmill belts. They consume 0 towels and take up 0 square feet of space during peak floor hours. They are a customer whose marginal cost of service is effectively $0, while their subscription revenue flows straight to the bottom line, with nearly 100% profit margin. Industry research across commercial chains reveals a mind-boggling financial truth. Approximately 2 out of every 3 paying gym members rarely or never use the facility they are paying for. Read that fact again. The overwhelming majority of the revenue base supporting low-cost commercial gyms comes directly from people who do not exercise there. This is not a flaw in the system. It is the entire mathematical foundation of the model. Consider the physical constraints of the real estate. A budget facility holding 7,000 paying members operates out of a space with a legal municipal fire code occupancy limit of roughly 200 to 300 people. If even 10% of those 7,000 paying members showed up at the same time on a Tuesday evening, 700 people would attempt to crowd into a building legally rated for 250. The local fire marshal would shut the facility down within minutes. The gym is not selling access to a physical workout space. It is selling a statistical derivative, a financial wager, that the vast majority of people buying a subscription will fail to use it. The physical facility only needs to be large enough to house the small fraction of members who actually show up. The unused, forgotten membership sitting quietly on a consumer's monthly bank statement is, mathematically speaking, the most profitable product in commercial retail history. This subscription engine creates a unique, highly volatile financial calendar dictated entirely by human psychology and seasonal behavior. Approximately 12% of all annual gym signups occur during a single 31-day window in January, driven by New Year's resolutions. Fitness operators pour their annual marketing budgets into this tight window, blasting discounted enrollment fees, low-cost trials, and massive advertising campaigns. January provides an immense cash injection, handing the business owner a wave of upfront capital and new recurring monthly billing files. However, the wave that rushes in fast washes out just as quickly. Industry metrics show that roughly 50% of all new members stop attending within 6 months of enrollment. For customers who signed up specifically as part of a New Year's resolution, up to 80% completely abandon their routine by the time summer arrives. February represents the single highest operational risk month of the calendar year, the exact point where initial psychological enthusiasm evaporates before a permanent behavioral habit is established. Novice gym operators make the fatal error of looking at their January revenue spike and treating it as a new permanent baseline for operational spending. They expand payroll, order unnecessary equipment upgrades, and draw excessive personal profits. Veteran operators treat January like a seasonal harvest. They sweep that surge of capital into an untouchable cash reserve, knowing it must subsidize the brutal, low-volume summer months when new signups drop to near zero and existing members cancel to exercise outdoors. If the entire business model depends on people paying for something they rarely use, a fundamental question emerges. Why do consumers continue paying month after month for an unused subscription? The answer lies in a combination of behavioral psychology and deliberate environmental friction. Psychologically, keeping a $10 to $30 monthly gym membership active acts as a cheap financial bribe to one's self-esteem. Economists call this a commitment device. As long as the fee hits your credit card every month, you preserve the optimistic belief that you are the kind of person who works out. Canceling the subscription requires an uncomfortable psychological admission, acknowledging that your personal fitness goals have officially failed. For $30 a month, most consumers would rather silently pay than confront that uncomfortable truth. The physical interior design of the gym actively reinforces this psychological retention. Floor plans are engineered with clear, open sightlines to eliminate the intimidation factor for beginner members walking in for the first time. Lighting is tuned strategically. Weight areas feature hard, directional overhead lighting designed to cast shadows and exaggerate muscular definition in mirrors, while recovery zones utilize warm, diffuse lighting to promote relaxation. Even background music tempos are calibrated to specific beats per minute to artificially push heart rates and reduce perceived exertion during physical workouts. However, when a member finally decides to break the psychological hold and cancel, they encounter the most controversial element of gym operations: engineered cancellation friction. Signing up for a gym membership takes 90 seconds on a smartphone. Canceling that same membership, historically, has required navigating a labyrinth of contractual hurdles. Operators routinely require cancellations to be processed in person at the local club during restricted management hours, or submitted via certified mail with a return receipt requested to a corporate post office box. Standard membership contracts demand 30 to 60 days of advance written notice before the next billing cycle, guaranteeing that the facility extracts at least one additional month of dues after the member has decided to quit. Furthermore, when credit cards expire or fail an event that accounts for 30 to 40% of all voluntary cancellations, gyms run dedicated billing recovery software systems that automatically retry failed cards, contact members through automated text queues, and apply administrative late fees before allowing the subscription to quietly expire. This extreme cancellation friction attracted intense regulatory scrutiny. The Federal Trade Commission moved to enforce national click-to-cancel rules, requiring subscription cancellations to be as effortless as enrollment. While legal battles over these rules played out across federal appellate courts into mid-2025, individual municipalities took aggressive independent action. For example, local legislation in major markets like New York City enacted strict rules with financial penalties exceeding $500 per violation for facilities that deliberately obstruct online cancellations. The regulatory pushback highlights a profound truth. If a gym's financial survival rested on delivering a service that active members loved, it would never need to make leaving the building so legalistically painful. The friction exists because operators know that a massive share of their top-line revenue comes directly from trapped ghost members. Beyond construction capital, equipment debt, and rental obligations, gym owners face a relentless layer of hidden parasitic overhead that catches almost every amateur operator off guard. Consider background music. Playing a commercial Spotify or Apple Music account over a public loudspeaker inside a retail business is a direct violation of federal copyright law. Under United States copyright statutes, playing music in a commercial facility requires public performance licenses from performing rights organizations like ASCAP, BMI, SESAC, and Global Music Rights. You cannot simply pay one organization. You must maintain active licenses across multiple groups to cover the full spectrum of commercial music. Annual licensing fees across these music organizations easily total $1,300 to $4,000 per location every single year. Ignore this requirement, and the enforcement is surprisingly aggressive. These organizations employ field investigators who walk into gyms with recording devices to document unlicensed song playback. Federal copyright law sets statutory damages for willful infringement starting at $750 per song, scaling up to $30,000, and reaching a catastrophic $150,000 per song if a federal court determines the infringement was intentional. A gym owner plugging a personal iPhone into the facility's sound system is quietly exposing their business to tens of thousands of dollars in federal legal liability. On top of legal licenses sit physical maintenance and utility costs. Heavy daily usage destroys commercial machinery at a staggering pace. Treadmill decks crack, cables fray, and synthetic leather upholstery tears under sweat exposure. A mid-sized gym floor routinely budgets $1,000 to $3,000 every month, purely for ongoing parts replacement and specialized technician labor. Utility bills driven by non-stop high-capacity ventilation, high-intensity lighting, and endless hot water for locker room showers consume another $1,000 to $6,000 a month. None of these individual line items sound catastrophic on paper. Stacked together month after month, they silently bleed away the exact operational profit margin the owner was counting on. To understand how quickly this high fixed cost structure can destroy even the largest industry giants, you only have to study the financial collapses of Bally Total Fitness and 24 Hour Fitness. At its absolute peak, Bally Total Fitness was the undisputed titan of the American fitness industry. It operated hundreds of mega locations nationwide, listed on the New York Stock Exchange, and generated massive top-line revenue. Its business model relied on high-pressure sales tactics that locked consumers into multi-year membership contracts, which were then aggressive, financed over 3 to 5 year terms, behaving more like auto loans than gym memberships. On paper, the accounting looked magnificent. By booking the full paper value of long-term financed contracts up front, Bally appeared hyper-profitable. But underneath the accounting surface, the capital structure was rotten. Aggressive sales tactics triggered relentless consumer protection, lawsuits, and federal accounting investigations. The company took on massive debt burdens to build out expensive facilities while failing to maintain long-term member value. When member defaults mounted and debt service obligations came due, scale could not save the empire. Bally Total Fitness plummeted into Chapter 11 bankruptcy in 2007, emerged briefly, and collapsed back into bankruptcy in 2008, before its remaining assets were auctioned off piecemeal to regional competitors. A nearly identical financial failure struck 24 Hour Fitness. Once an industry-dominant brand with hundreds of thousands of active subscribers, the chain was loaded with immense private equity debt obligations. When operational disruptions hit and fixed occupancy costs remained locked in, the fragile connection between high debt payments and real liquid cash flow severed instantly. 24 Hour Fitness filed for Chapter 11 bankruptcy protection, closing over 100 locations permanently. The macro takeaway for any investor is profound. Neither of these multi-million-dollar chains collapsed because Americans stopped wanting to exercise. They collapsed because the mathematical link between fixed occupancy costs, debt leverage, and actual reliable cash flow broke down. Packed parking lots and thousands of members on paper mean absolutely nothing if your underlying balance sheet is structurally over-leveraged. So, how does a mid-sized commercial gym actually make real, sustainable money once it survives the capex build-out and debt obligations? The basic mechanical engine rests on a simple formula: monthly subscription dues multiplied by total paying members minus fixed monthly operating costs. Assume a mid-sized commercial gym facility carries total fixed monthly overhead of $30,000. This includes commercial rent, property taxes, equipment, debt service, basic payroll, utilities, insurance, software licensing, and marketing. If the gym charges an average membership rate of $89 a month, simple division reveals the break-even threshold. $30,000 divided by $89 equals precisely 337 paying members. Below 337 members, the business loses liquid cash every single month. Above 337 members, every additional member acquired represents near pure operational profit because the marginal cost to serve an inactive Ghost member is practically zero. The danger lies in the ramp-up phase. A newly opened gym rarely achieves its 337 break-even member threshold on day one. It routinely requires 12 to 18 months of aggressive member accumulation to reach sustainable profitability. Every single month during that ramp-up phase burns through the owner's pre-opening working capital reserve. If marketing execution is poor, or if a competitor opens nearby during that 18-month window, the working capital runway expires, driving the business into insolvency before it ever reaches profitability. Furthermore, subscription revenue is plagued by annual churn. The average commercial gym experiences annual member churn rates sitting between 30 and 40%. If a gym maintains 500 members and loses 5% of them every month, it must acquire roughly 300 brand new paying members every single year just to maintain its starting position. That is not growth. That is running on an operational treadmill just to stand still. To beat this churn math, successful operators introduce high-margin secondary revenue streams, most notably personal training arbitrage. A single trainer conducting traditional one-on-one personal training sessions faces an unyielding labor ceiling. At an average rate of $80 per hour, capped at a maximum of 25 physical sessions per week to prevent total physical burnout. A solo trainer caps out at approximately $100,000 in annual gross revenue. You cannot add more hours to the clock. Smart gym operators bypass this labor ceiling through semi-private or small group training formats. A coach running a semi-private workout with 4 clients simultaneously, charging each client $40 per hour, generates $160 in gross revenue for that single clock hour. The hourly revenue double, while each individual client pays half of what one-on-one coaching would demand. After paying the trainer a 30 to 50% commission split, the gym retains 50 to 60% of that high-margin hourly yield to cover space, floor equipment, and net owner profit. Across a full roster of active clients, personal training converts unused floor space into an aggressive cash generator that subsidizes basic subscription churn. When you consolidate all these financial variables, 2 completely distinct real-world outcomes emerge for a single mid-sized commercial gym facility. In the optimistic scenario, you secure a pristine location inside a high-density, high-income 15-minute demographic bubble. You execute a strong pre-opening marketing blitz, hitting your 337-member break-even threshold within 7 months. You keep member churn suppressed around 25% through high-quality semi-private personal training offerings and automated billing retention systems. Under these ideal operational conditions, a mid-sized independent gym generating between $500,000 and $1.5 million in top-line annual revenue can deliver a clean net profit margin of 10 to 20%. That translates into an owner take-home compensation ranging from $70,000 to $180,000 per year, a genuinely solid return for the capital, risk, and operational labor invested. Then comes the realistic scenario. 2 or 3 standard industry risks materialize simultaneously. Member churn runs at the high end of normal, hitting 45%. A national $10 a month budget chain opens a pristine 30,000 square foot facility 2 miles down the road, draining your price-sensitive subscription base. Equipment wear accelerates, throwing unexpected $3,000 monthly repair invoices onto your desk. Under these standard market conditions, that exact same gym facility sees its profit margins compressed from double digits down to low single digits, or plunges into direct monthly cash flow losses during quiet summer months. Even as the parking lot outside looks reasonably full on Monday evenings, the business bleeds tens of thousands of dollars a year underneath the surface. The ultimate verdict of the fitness industry is as brutal as it is undeniable. Owning a successful gym was never truly about how many passionate people you can convince to walk through your front door. It is entirely about how masterfully you can structure your balance sheet to survive on the recurring payments of those who pay, turn around, and quietly stop showing up.